Hello and welcome to our market alert video for today, which is June 21, 2024. Thank you for watching. I am Ken Moraif. I'm the CEO of Retirement Planners of America. And as you guys know by now, I hope, our singular goal is to create as many squippers as we possibly can. And if you don't know what a squipper is, it's the acronym for Second Childhood Without Parental Supervision. So when a client of ours retires, we call them a squipper, and we want them to go out there and be a kid again. Enjoy, play, have fun. You earned it. Let us worry about all this boring financial stuff for you. And that's when we call them a squipper. So thank you for watching. So I want to update you just quickly before we get going. Had my grandson here for about 4 days and hadn't seen him in a couple of months. And it's remarkable. He's about 2.5 years old now, a little over. And it's remarkable how quickly he is learning to formulate full sentences. He can speak so well now. It's crazy how well he can say no now in a complete sentence. Before he'd just say no and have a temper tantrum. Now he says, no, I will not put my shoes on. No, I don't want to do that. No, I don't want to go to bed. He's gotten really good at creating full sentences. Anyway, so let's talk about the continued drumbeat of financial information that we're getting. This week, we got retail sales, and they came in lower than expected. But more importantly, they revised the retail sales numbers from last April, and they revised them downward. So that's a sign that the consumer is slowing down. And since the consumer represents 70% of our economy, that's concerning. The second part that was also concerning is that the home starts, easy for me to say, home starts were the lowest since 2020. And guess what was going on there? The pandemic. So since real estate is now 25% of our economy, and the other 70% of it is our consumers, that's 95% between the two of them that are slowing down. And the challenge that creates and why we're concerned that we may actually slip into a recession is because our economy is a giant oil tanker. It's a giant ship. And to turn it, you can't turn it on a dime. You have to start turning it way in advance. And the captain of our ship, of our economy, is Jerome Powell, the Federal Reserve Chairman. And they are sitting on their hands waiting for the data to tell them when it's time to start lowering interest rates. Well, the problem with that is that data is backward looking. And so if the data is telling us that we're headed into a recession and now they decide to do something about it, well, you can't turn this thing around that quickly, and the momentum could build on itself, and we could have a pretty significant recession. There is historic precedent for this. It happened back in the early 80s under Paul Volcker, who was dealing with the worst inflation at the time that they'd had in decades, sort of like what Jerome Powell is dealing with now. So it is a risk. Now, in our view, it's not a large risk, but it is still a risk. And in our view, always, especially if you're over 50, retired or retiring soon, which is who we primarily work with, we think it's important to have a plan to protect against the downside. We in our firm, we have a plan, we call it Invest and Protect. It's our strategy to address bear markets. And it helped us to be out of the market during all of 2008 when the credit crisis came, and we had a 57% drop from peak to trough in the markets. In 2020, with the pandemic, it told us to sell literally the day before the pandemic was announced. Coincidental, but it did happen. And so we want to protect our clients from the bad markets on the downside. We believe that protection, that growth is important, but protection is even more important. And if you're over 50, if you are retired or retiring soon, we believe you should think that way too. So start thinking right now, in our view, of protecting what you've built. We've had a tremendous year so far, tremendous 12 months or 16 months since the market really turned around, and it's been remarkable. And so we could be due for a what's called a correction, which would be a 10 to 20% drop. It would not surprise us if we saw that. But if the Fed mismanages the economy's slowdown, which we're seeing now increasing at an increasing rate, then we could have a bad recession. and that would turn into more than just a correction. It could turn into a bear market. So our view right now is we don't give it a high probability that that's going to be the case, but it is increasingly possible and therefore increasingly necessary in our view to have a plan to protect against it. So if that resonates with you, visit with one of our retirement planners. We'd love to help you. So that's where we are for now. Thank you for watching, and we will talk soon.